I appreciate the ability to actually be the MC for this panel. It's something I always look forward to in most of these conferences. It's an interesting title. If you look at your book, the title is What Assets to Focus On, Where to Invest Geographically, and How to Finance the Deals That I Cannot Control. Basically, that's a capital markets kind of kickoff type title. So what we actually have here, we have a very distinguished panel today. We're going to make this into kind of a open discussion. I'm going to be the MC. I'm going to ask questions. Some of the team here will probably end up doing a little point-counterpoint. We had a little pre-conference call last week. People were trading ideas and thoughts. Also, at this point in time of the year is when we'll find out a lot of people are going to similar conferences like this, the MBA, CREFC, things like that people will have probably some comments about what's the national buzz. So we're going to take a little more of a national or macro approach. Of course, that impacts you locally, depending on whether or not you're institutional, non-institutional, or non-commercial grade. At the same time, I think one of the things you'll find is that the comments that are made here can be kind of broad-brushed enough where they impact Florida as well as the rest of the United States. So without further ado, I'm going to give a quick name and title to the panelists, and they're going to then give a little 10-second or longer commercial about what their role is with each of their companies. Immediately to my left right here is Chris McGibbon. Chris is head of the real estate for Americas for TH Real Estate. He actually is also a graduate of the MBA program at the University of Florida, so that's a little tie-in. Next to him is John Geanakos. John actually I was glad John showed up because he was texting me, and I was trying to make sure he was going to be here. He's president of the Americas Capital Markets for Jones Lang LaSalle, JLL. And on the very end, we have Mike Riccio, senior managing director, co-head, national production, CBRE, debt and equity. So you have some very strong players here from kind of a national standpoint. I'm going to let each of these folks kind of talk a little bit after I give a little setup question, but Ryan kind of alluded to it. There's lots of positive things that are going on in the commercial real estate in general right now. Demand is growing for a lot of product types in a lot of markets. Supply is in balance, although some people may argue about apartments in certain markets. Debt capital is available. We'll talk about that, and they're relatively cheap. So there's many other supporting kind of pillars out there for those who are in the commercial and institutional real estate space. At the same time, we are facing a lot of issues. Ryan was bringing those on. We're not going to get into a lot of the regulatory and political world, but that's one of the things that's facing us here in the short term, long run. We're also long into an economic real estate cycle, as well as long into an economic cycle. So a lot of people are questioning how much longer does that actually go. And then obviously we're looking at global capital flows, and sometimes that is also regulatory, or it can be done both local, domestic, and particularly with a lot of the foreign capital coming to the United States. Is it coming and going? What's the net positive or net negative of that? So we're going to kick it off really quick. I'm going to ask each of our panelists, I'm going to let Chris go first, just to give kind of some of his opening comments and thoughts about where we are, general house view on investing or lending, because we have both debt and equity folks up here with their backgrounds, and what's their current view of the commercial real estate markets going into 2017, since this is a trends conference, and maybe a little bit further. So Chris, without further ado.
Thanks, Chuck. And thanks for the opportunity to be here. It's good to see Dr. Ling and Archer and others again. It's quite some while ago. It made me realize that I better be a little careful about dropping statistics or return information or whatnot, because the fact-checking will be fast and furious, I'm sure. So since I left Florida 16 years ago, I've been at formerly what was TI Cref's real estate group. About 2 years ago, TI spun off its real estate group with a joint venture with Henderson, a big UK asset manager, and that's where the T and the H come from. So today we are an arm's length, wholly owned real estate asset manager. We still manage on an arm's length relationship the two big real estate portfolios of TIA. Some of you are probably invested in one of them, the separate real estate account, which is available on our pension platform, as well as the real estate allocation of the general account, along with 78 other mandates globally in all different kinds of structures and funds, private equity, private debt, public debt, and a little bit of public REIT space. And that's on behalf of 400 investors, primarily institutional investors, a lot of pension plans, sovereign wealth funds, endowments, and about 80% of our platform is equity, and the other 20% or 20 billion or so is commercial mortgage and debt-related securities. As far as where we are, I think everyone loves to talk about what inning we're in. My personal view, and I get a lot of flack for this since I'm the head of a big real estate platform, is I have no idea. The one thing I do know is that no two cycles ever look the same. So yes, we're 6 years into double-digit total returns in a core equity index that typically does high single digits. So that would make you feel like the cycle's getting a little bit long in the tooth. But I think we make a big mistake by looking at 2008 and 2009 and using that as a proxy for what might come. Because in the last 70 years, no two real estate cycles over the 6 or 8 that there has been have ever looked the same. Not the same magnitude, not the same duration, not the same cause, not the same thing that pulls them out. And while it definitely feels late in the game, there's a lot of positive things out there too. I think construction is still relatively in check, although some markets that's not the case. But in general, we're still enjoying double the net operating income growth in a large portfolio than the average over the last 20 years, and enjoying, it still feels pretty good to be a landlord for the most part. So wherever the downturn is coming from, it hasn't shown itself yet.
Good. Well, thanks, Chris. I appreciate that.
Are you saying it might be different this time?
Well, I think the cycle is, the paradigm shifts are probably somewhat overrated. Like, there will be a downturn. I think using 08, 09 as a proxy is probably not it probably won't look just like that.
Thanks for those comments, Chris. John, can you go next?
Hi, everybody. I'm Geanakos. I don't really have anything to do with Florida other than I do go to the Four Seasons in Palm Beach on occasion. So if you hear a Boston accent, just roll with me. As everybody knows, JLL is a large Fortune 500 public company. We're in 80 countries, 70,000 employees. I oversee all of our capital markets activities for North America. Just to give you a sense of scale, over the last 3 years in the U.S., our group has done about $150 billion, sales financings, M&A, corporate structures. We've done about $400 billion globally, so we're quite active, quite busy. I'm going to share Chris's view. I try to compartmentalize my views on where I see things. I do watch CNN, I do read the Wall Street Journal like everybody else does, and there's an enormous amount of vagary and opaqueness to everything we read. It becomes very, very confusing. But when I contrast that to all of the investor conversations that I have both here, the Middle East, and Europe, it's remarkable how people's views on investing and how they approach allocating capital on behalf of their clients really is decoupled from it, and that's sort of a calming thing for me. As we look at where we are in the cycle, I have mistimed rates rising and things falling, I guess now 3 years running, so I've stopped. There's about $250 trillion of liquidity dedicated to North America. The preponderance of that is in the U.S. So when I look at allocations, when I look at our bidder pools, while I expect in many cases things to thin out on a broad basis, they haven't. Investors that were interested in real estate, specific assets, specific markets, specific themes before November 8th haven't changed their cadence at all. They're still focused on what they do. The good news, I think, as I sit here, and we'll talk about debt capital markets in a bit, with the exception of the agencies who have sort of reduced proceeds a tad, maybe spreads have widened, there's an enormous amount of liquidity in the debt markets, whether it's the insurance companies, the banks, the CMBS marketplace. It is a wonderful time to be a borrower. It is a wonderful time to go long if you can on rates. How long will it last? I don't go to Vegas other than to go to ICSC, so I will stop with any predictions. But we're largely confident that things are going to continue the way that they are. Again, while we are worried about fact patterns, we are worried about where things are going to go, all the things that the gentleman spoke about earlier in terms of policies. No one has any idea what's really coming out of Pennsylvania Avenue ultimately, but with the amount of liquidity that's in the market, the amount of discipline that the lenders and the equity investors are showing, I'm generally positive about it, but being in middle age, I'm a bit pragmatic.
He's very honest, very honest. All right, thanks for those comments, John. Mike, why don't you give us the last lead in there?
Good afternoon, and thanks for having me here. My name is Mike Riccio, and I have to tell you the most important thing I may say today is that I'm an official by marriage Gator, because my son-in-law is a Gator, and my daughter met him in Atlanta, and they moved up to the Connecticut area, so I become a huge Gator fan, especially since the Huskies aren't so good anymore. But really happy to be here on this great panel, and most of you know who CBRE is, also with JLL, one of the largest real estate services firms in the world. We also are in probably one or two more countries than John's firm is in, but all over the place. The capital markets business at CBRE includes, debt and structured finance, which I head nationally for our firm. It includes investment sales and our investment management and investment banking firms. So I also take care of a few of our largest institutional clients, so I'm in the market on a day-to-day basis, working with clients, as John is as well. And I think the house view is a little similar to what you said. I think you meant to say rates are up. Yeah. Spreads are not up. And if you listen really carefully, I just came from the MBA in San Diego yesterday, and I can still hear it. That's the sound of spreads compressing. So what's happening is, I think spreads are compressing, and there's a couple of reasons for that. I'm talking about spreads on loans that lenders are charging. One of the reasons is there's a little slow start to the year. The deal flow in the U.S. at least is down from where it was last year at this time. So there's fewer deals, so lenders that are going after deals are decreasing their spreads a little bit. The second reason is interest rates. The treasuries and the indices that we use to calculate commercial mortgage rates are up. You all know they went up pretty precipitously since the fall, and because of that, lenders feel a little more comfortable with where rates are, so they're able to compress spreads a little bit more. And the third reason is because it's a brand new year and everyone's got new allocations of cash. They want to put all that money out. So, and with fewer deals, lots of money to put out, it's really having that supply and demand effect, and spreads are coming in. I would say the house view, I'll be brief because there's lots of stuff to talk about here, that the fundamentals across property types, across geographies, are pretty stable. We've got great supply and demand characteristics in the market. Lenders think that, borrowers think that, and that's really a good place for us to be. I think real estate has become a very accepted asset class, and it's been underutilized in most pension funds, and they're trying to get those allocations up. And the U.S., as far as international investing, is really considered to be a safe haven. So we're seeing capital pour in from every direction. But not only is it a safe haven, it's actually a good return relative to international returns. So we expect 2017 to be a pretty good year for real estate investment.
Good. Well, thanks for all those opening comments. We'll go back kind of to the title. And maybe, again, Chris, I'll start with you, and then we can start jumping around a little bit. What assets do you focus on at TH Real Estate right now? I mean, where is the game being played? Everybody's yield hungry. Don't want to take too much risk. Got a lot of things kind of holding you back, pushing you forward. Kind of what are you looking at where you think you can play?
Yeah, Chuck, it's very client-centric. So I would say 3/4 of our investor base take a very strategic long-term view, and about 1/4 are more tactical. So they want to get in when things feel cheap, 2010 or so, and they want realized returns, money in their pocket. They're not okay just looking at appraisal values over long periods of time, and they want a round-trip investments, to call it a deal. I think for those type of investors, this is a net selling, time. I think nobody really knows where we are, but I don't think anyone's going to fault you for selling in 2016 or 2017. That being said, last week I was in New York with one of our partners, and we did our first deal with them in 2010. And this is a New York family that owns a lot of real estate in New York City, and it's a 3-generation family. So the grandfather is now out of the business. I was dealing with the dad, and then the son is taking the business over now. And he said to me, Chris, there's only 2 things you need to know to get rich in real estate. And when a billionaire, starts a conversation like that, you kind of lean into the table a little bit, and he said, the first thing you need to know is you keep your leverage low, and the second thing you need to know is you never sell. And I said, what do you mean you never sell? And he said, well, the building that we just walked by over there, like his father bought for the same price per square foot in 1976 is what the rents are in the building today. So I think he paid $60 a foot then. Now he's getting $60, a foot in rents. And no, you can do the math on all that. It's probably just with compounding and whatnot, still, maybe a low double-digit type return. But his point is that's pretty darn good over, multiple time frames and cycles. And he said, and the number of times that they've been offered 100 a foot for that building, and then 200 a foot, and then 400 a foot, and then 800 a foot over the last, 40 years. Every single one of those times, they would kick themselves for not taking it, but then look really smart 10 years later. So it doesn't mean that there's going to be, not be moments within a cycle where, you can get out. But once you get out, where do you put your money in today's environment? Where do you go back in? So I think, this strategic long-term approach, if you can, have that kind of horizon and stick with it, it proves out for most of our investors.
This is actually unbelievable because I came from a city, I would rather not say which one it was because it might give it away. And I was with one of the largest family offices in the United States. I was with the grandson. And the grandson looked at me and he said, John, my grandfather is 92 years old, and he said he now believes that the next 20 years are critical to the company's growth. And I listened and I said, and what's his view on his activities in terms of the next 20 years? He said, well, he thinks he's going to stay very, very focused for the first 10 and try to give me a chance to sort of learn the balance of the time.
It's a good time.
But he's also an optimist, right?
Yes.
But I think I'd share Chris's views. We talk to so many different investors that, again, have tactical and strategic needs, from the family offices that make an investment purely for the reasons you mentioned, where it's a duration, it's much like the Middle East and other places where these are generational or even greater holds. We have others that are, many of the people that are in New York with the 212 area code, where their attention spans and their hold periods are quite accelerated, and we have to deal with that too. And I think the challenge for us in many cases is when you look across the return prism that we deal with, many times you'll have folks that will try to use leverage or optimism to take a core plus deal and make it opportunistic. And while we're always optimists in the investment management or intermediary space, we have to be very careful that when we go and speak to owners about how we're going to market their assets or recapitalize their companies, you have to match the capital precisely to the execution. And I think we all get tied up in this wave of capital story. But when you look at a situation, whether it's your platform or our types of clients, there's a very precise approach to the execution, and there's a very precise counterparty to that execution. So when somebody will say there's 100 people that are interested in your company or interested in your investment, in your building or your loan, there really isn't. And I think our job today is to synthesize that data very aggressively and get to truth as fast as we can. So.
Go ahead, Mike.
I guess
you were going to make a comment.
I guess if you want to talk about property types and what sort of the favored asset classes are, apartments have been the darlings of the last 5 or 6 years, ever since we came out of the recession. And that really started during the dark days in 09, 10, 11, really, because Freddie and Fannie supported that business throughout that cycle when there was fewer dollars in the market. And the government agencies supported that business. And up until probably very recently, it was probably the darling of all the property types. But the new darling of real estate property types is industrial. And people can't get enough of it. It's less capital intensive than certainly office and retail, perhaps. We won't talk about hotels here for the moment, but industrial is certainly the new darling. I was in we had 120 meetings over the last couple of days. I wasn't into all of them because I couldn't do that. But every single owner and lender came to us and said, we wish we could get more industrial. We wish we could get, and the supply and demand characteristics of that industry today are better than they've ever been in the history of since we've been keeping track.
Yeah, that's an interesting comment. Some of the folks in my office here in Atlanta will actually say, you've been trying to build your retail portfolio, okay? And I go, gosh, it's so hard. What do I buy? Do I buy a grocery anchored center? It seems like the yields are nothing. They're low single digit, where they are. And do I buy a power center? Then I got to worry about the big boxes. Are they kicking in and out? Every time I look at one on behalf of a client, I'm always like, gosh, how do I underwrite this big chunk of space? Is it a power village? So some of you all remember in the old days, you would never invest in retail where there was a movie theater or a restaurant. Now, if you don't have those, you're upset. And if you can throw in a grocery, that's even better. So these things are becoming mixed. And I said, I'm not really worried about not having exposure to retail, and particularly the Southeast in my office. And they said, why? I said, well, I have 2 million square feet out to Best Buy, Office Depot, and Tory Burch. And I just finished those buildings. So there's my retail exposure. So you're right, there's been this kind of seismic shift there. So I'm not sure if Chris, you've seen it. Do you ever have clients who say, I need more retail and that diversity? Maybe I'm not just doing apartments, I want to go into another product type. Are you in this kind of part of the cycle when you're now, it's not easy anymore, right? So
Yeah, no, I think for sure, especially you mentioned the seismic shifts. I think there's some other panels like later today and tomorrow that'll cover this. But we were at an advisory board meeting last week, and also in New York, and the theme was these people had been reading the Wall Street Journal and everything else, and they're like, hey, we own all these regional malls. The world's coming to an end. What are we going to do? And I said that I don't think there's any better investment in the U.S. than a top decile regional mall, and probably no worse investment than a bottom decile regional mall that's on its way to becoming a skating rink or something else. And so, I think there seems to be, it's you do more sales out of an Apple store now than you could do out of 60,000-foot Macy's, and maybe the limited brands. I think everybody remembers like Peter Lynch's book, when One Up on Wall Street, when his daughters bought limited, clothes, and this is 20 or 30 years ago, and he just went and bought the stock, and it turned out to be great. Well, they just filed Chapter 11, and they're closing all their stores. So, what's tomorrow's, limited brands? What's, is Under Armour the new Nike? Is Shake Shack the new McDonald's? I mean, I think just trying to figure out what tomorrow's retail is going to look like is a challenge. It's something we spend a lot of time on. And as far as like new product types, the biggest thing that keeps me up at night is what is real estate going to look like in 5 and 10 years? And things like not just the 4 main property types, because those are changing, but healthcare. You look at these themes and you think about healthcare as a percentage of GDP continues to grow globally. Well, how do you access it? How do you put like pools together around that? Urbanization, the trend of populations moving from west to east, the whole concept of sustainability. Well, not sustainability as I just checked the box and I made it like, okay, I'm a green building, so now you'll sign a lease, but how do you create an alpha generator with sustainability? How do you actually charge extra for it and turn it into a return generator? I think those are things that, when you start talking about those kind of pools, and not just from, identifying the mega trend and the research case behind it, but showing them an investable portfolio or pool, that seems to be getting investors excited right now.
Well, and we can kind of jump around a little bit. So, one of the things that always comes up when we have kind of a broad audience here, our panelists on our pre-conference call, we're going to get in a little bit to the geography or markets. So let's talk about if we see any imbalances or places where we should be cautious. Do you see that anywhere in the U.S. by product type that you're concerned about? I don't know, John, maybe you give us, you're talking to investors and whatnot, and you're seeing what's happening in your own platform.
It's interesting because, again, we're generalizing a lot, which is difficult. But a couple of examples. So we were in a meeting with probably the largest money manager in the world, and their head said to me, I think that retail is effectively in secular decline. And with the exception of the top decile mall, or the best of the grocer anchored, or any true experiential retail environment, we're not an investor, period, red line. We talked to others who are value creators in the B-mall space, and they think the risk-adjusted returns are incredible, perhaps unprecedented in their career.
And they need to be.
They do. And they've got opportunistic capital that says, sure, we'll do a 95.5 or a 90.10, and if you're right, great, and if not, we have a decent basis, and we'll go from there. It's interesting, we grapple a lot with office, because office is a very generalized term, and something that we're seeing, again, how does one define urbanism or urbanization or urban light or whatever it is? But suburban office, much like B malls, has sort of been cast asunder by most investors. But we now have new capital sources who had basically said over the last 3 to 4 years, we're out of suburban office, who are now looking at it and saying, can I create a criterion that creates an urban or close to urban environment, but at a highly advantaged basis in suburban product type? And they love it, and they go after it pretty aggressively. And we were actually surprised because these were the same people, as I said, only 2 years ago that were not interested in it at all. Industrial, to your point, continues to be remarkably liquid. It's extremely difficult to assemble. We think that there's more portfolios that are coming out this year. But what we're finding is, especially in offshore capital, if they can't amass sizing, they're effectively penetrating at the entity level. I think a really good example, and we'll talk about foreign investors, I guess, in a bit, is Mitsui's purchase of 20% of CIM, and also setting aside $400 to $500 million for their forward commitments in their funds. We're seeing a lot more of that where people say, I'm not necessarily sure if I know the product type that I want to be in, but I know the theme that I want to penetrate. In the case of CIM, it's high value add and it's urban. And Mitsui knew that that was a great way to penetrate that space and to do it in an efficient fashion. So the last point I'll make is on healthcare. We've seen what's been happening in skilled nursing, and we've seen what's been happening in terms of medical legislation, what's going to happen with the Affordable Care Act, which is we have no idea what's going to happen. But medical office, clearly a very powerful and interesting product type, especially now since doctors who had historically been the capital and the LP are now starting to move away because they're disadvantaged based on how they carry their insurance. So we think medical office is an interesting place. Self-storage is sort of an interesting niche. We've had investors come to us and say, we understand that there's strong control of those assets in the public space, but there's an enormous amount of mom and pops that control those assets. Can we find a way to aggregate those families? To which I have absolutely no answer. But again, those are some of the things that we're hearing, which they're sort of all over the board.
Well, Mike, just so we get up, I want to make sure that we talk about regional aspects, certain MSAs. When we came out of the recession, everybody said, let's do the, sorry, it's going off and on. Let's go to the 5 or 6 top markets. Now it seems like there's a little bit risk off in some of those markets. Some markets are building way too many apartments, for instance. You mentioned apartments. Is there really a capital flow back to secondary and tertiary markets? The reason I bring this up is because, John, you're talking about suburban. That's also a trade-on, trade-off kind of thing. But I don't know, maybe you can give us a little bit of insight from your standpoint, John, because you're talking with investors, you're providing capital. Are there certain places they will now go that they used to not go to, or are the old ones not where they want to go anymore? Just any thoughts on that?
Mike or me?
I mean, Mike, I'm sorry. Sure. I'm looking at
well,
you, John, sorry.
I think it depends on the capital. If you're talking international investors and they're coming in to buy scale, they really want to be, and they also really want to be in places they know. They want to be scale in places where when they're at their cocktail parties in Abu Dhabi and they want to say, we bought a hotel in New York. If you say we bought a hotel in, Des Moines, they might not know, that might not have the same cachet. So they really like to be in major markets, in their coastal markets. Believe it or not, the best non-coastal market that international capital is going to is Dallas. And you'd think it might be Chicago or Atlanta, but it's Dallas. And so Dallas become one of the, I think, very attractive cities to international capital. What we found over the last couple of years is in the search for yield, people were going from the top markets to the second-tier markets. So we like to call them the primary secondaries. So there's the primary markets, but now we have primary secondaries. And they would include places like Denver and Charlotte and Atlanta and Austin and places like that. And those, even places like Raleigh, in Nashville, and some Orlando. So I think that there are, the issue is that yield differential has really lessened. So where there used to be a little extra yield in those markets, there's really not anymore. while the top tier markets, the top 3 or 4 will still have the lowest cap rates, the New Yorks, the LA, San Francisco's, Seattle's, maybe DC, and maybe Boston. Other than that, the rest of them are there's not a whole lot of difference in yields. So the hunt for yield then goes to either suburban or it goes to property type, when you mentioned a couple of those. So, and those yields are shrinking, the differential in those yields are shrinking as well.
Sure, Chris.
Maybe I can add a little perspective how we look at it. So I have a very scientific test on market selection. Essentially, if you're flying out of an airport and 20 minutes after you take off or before you land, all you see is cow pasture, we don't invest there. And the idea is that, to me, the number one driver of total return in real estate, and this is not scientific, this is from a lot of mistakes I've made over the last 20 years, is supply constraint. Like, yes, you have to have demand drivers, and places like Charlotte and Raleigh are great because everyone's moving there, but they're not supply constrained. And I live in Charlotte, and we have an office there, but we don't invest there. Because I think that when you can go to the next intersection out and add a building pretty much on any corner you want, and you can get, permits and, entitlements within a few months because you're creating 100 new jobs, the supply spigot is just too easy. And so rents will never get past a certain level because developers are smart. As soon as the rents hit that replacement cost level or better, they're going to build. But if you try to do that in New York City, it'll take you 3 to 5 years to get air rights and entitlements and permits, and then you're adding a new building of 500,000 feet in a 400 million square foot market, so it's like a drop in the bucket. You try to get permits and entitlements in California, with all the things going wrong in California, total return and in the long run, landlord pricing pressure to raise rents is great because it's really hard to add new supply. When you're going to fly into LA, you look out the windows, and for 45 minutes before you land, all you see is rooftops. If you want to build something in LA, you got to knock something else down if you can get permission to do it. Now, those markets, agreed, are always low cap rates. It never feels good to buy in a coastal infill market. Never. Even in 2010, it wasn't like, picking anything up cheap. But I think over full cycle, that window where you actually have pricing power as a landlord will be longer, and the total return will compensate you for it. And I think places like Atlanta, Dallas, Chicago are, I think people are fooling themselves a bit to get an extra 100 or 200 basis points in cap rate with what will be a much longer vacancy time, a much bigger CapEx check when they're trying to lease that thing up on the other side of a cycle. And, in total return, you probably actually get paid for a lower cap rate, compensated over longer periods of time for the low cap rate by virtue of that pricing power.
So just 2 examples of where generalization kills us, right? So I was in Chicago for the last couple of days, and we always used to laugh that the best thing about Chicago is if you buy now or you buy in 10 years, the rents are the same. They may go up and down a little bit, right? So in Chicago, the big and amazing push is in creative office space, and in particular, creative office space with extraordinarily large floor plates. And what we found in our studies, we actually pitched 2 very large deals with that profile this week. There's nearly 100% occupancy in that sleeve of office product in Chicago, which belies the other sides of the market. So there's a generalization about Chicago. I've been wrong about Dallas, I think, since the 90s. So you were mentioning about you go a little bit longer and you build a little bit more. I was wondering what new town they were going to create every 5 miles up
Oklahoma.
every 4 or 5 years. Right? It's just unbelievable. And I was wondering if there were wood placards behind the building fronts because it looked like a stage. But Dallas is incredibly liquid. Now you look to places like Seattle or Portland, who clearly have themselves confused with San Francisco. And there were times when Portland was viewed to be an exitless place, and if you weren't the Schnitzers or somebody else, you didn't buy or build there. Now it's incredibly attractive. People from the Middle East and Asia are actually investing in Portland, which is fascinating to me. And Seattle, we've just priced 2 very large deals there, and those cap rates feel like New York City. So again, we do carom across trying to find relative value, but I do share Chris's view that when somebody seeks out a pure return-based deal just because of basis, that's folly to me. And if they'll pay a high price, we love them, they're our favorite buyers. But if I was an investor, that wouldn't be where I would go.
So, well, I have a question for you, Mike. So you hear this going on. Some of these markets are hot. Let's talk a little bit about leverage levels. Right now, we were kind of talking, even at our table, we're talking about interest rates. interest rates maybe going up. Ryan's not sure. Maybe the regulatory world, maybe the Trump effect, interest rates are going up. We hear noise from the Fed. Do you guys really think cap rates are going to go up? Do you really think you're going to see debt yields are going to stay low because people have to get money out the door? Because we're talking about capital flows a little bit here, about market and product type. But how does that really impact leverage levels? I mean, it's been very disciplined coming out of the recession. So just your comments.
Yeah, a couple of things. I've been only doing this since 1981, and we have been projecting interest rates are going to go up for 35 years, and we finally were partly right last year for a short time. So I don't know where interest rates are going. I can tell you that they are still at an historically unbelievable low rate. I mean, the Treasury rate, the 10-year Treasury was under 2%. Prior to last year, 4 times in its history, which goes back to the beginning of the U.S. settlement. 4 times, 4 months, and 2 times were in World War II, and 2 times were in 2011. So they're still incredibly low. I think they're going to stay low, but that's not necessarily the House view. That's my view, and I have no basis to say that, but this is my thought. As far as leverage levels goes, when you talk about real estate underwriting today from the debt perspective, we're seeing incredible discipline on lenders. Lenders are being incredibly disciplined. They're not doing anything that I would call stupid. Not even CMBS, which is the first place stupidity shows up. It hasn't showed up at all. In fact, the discipline there is just hard to believe because you can't get an 80% loan. Now, there are exceptions, but in general, you can't get an 80% loan from a securitized lender. Now, I'm not talking about Freddie or Fannie. So leverage levels are very safe. That's what I teased you a little bit, Chris, when I said maybe this time it's different in the beginning, because I do think it's different. It feels different. You said, John, you said it too. It's like this is not 2007, 2008. I think we have a lot of run room because of the discipline, both from the banks, as far as construction loans. We can talk about that in a minute. But there isn't a huge overbilling. It isn't in the early 90s either. So I think leverage levels are conservative. And if you talk to differences in leverage levels, we're not seeing a whole lot of difference between a leverage you can get in different geographies or really by property types, except maybe if you X out hotels. I think people are keeping that even lower, maybe tops at 60%. CMBS might go to 70% on a hotel, but a life company or a bank usually wouldn't. So very, very good LTV loan leverage.
So we don't really have a bubble happening in the first.
We don't have what?
We don't have a bubble happening in the first mortgage. I'm trying to find things that would cause us to come off the tracks.
I think I have something that's a little bit scary. It scares me. So if you look at the whole $500 billion NCREIF index, so 7,000 or 8,000 properties, I mean, it's a pretty good proxy for commercial real estate. I think it's valued at a sub 5 cap right now, the entire index. And so I'm not an economist, but our chief economist thinks that we probably could see 100 basis points of interest rate widening in the next 18 months, especially with some of the policies that they're coming out of this administration. They're not passed yet, but they're indicating that they could be very pro-growth, which could create inflation and widening interest rates. If that happens, I mean, you think about going from a 5 cap to a 6 cap, and that's the NOI growth that's happening right now is not near enough. Even though it's double the long-term average, it's not even half of what you would need to keep pace with that kind of like widening in cap rates. So I think we could definitely see capital values. I hope it looks more like a 2000, 2001 scenario where it's pretty short too. It's short and it's it's off just let's say single-digit percentages annually, because I think the market can absorb that as long as it doesn't happen too fast, too rapidly, or with some sort of other shock, either geopolitical or otherwise. I think people will be fine. They won't get too panicked, and I think we'll be okay. But I don't think sub 5 cap is a new norm in the long run. But we'll see.
I mean, Chuck, from our perspective, and this is not a house view, and I hope there are no cameras rolling or shareholders of JLL when I say this, but we talked earlier on about there being a decoupling between what's happening on Pennsylvania Avenue and what we're doing in Investment Committee. And we talk about the fact that rates will probably rise on some basis because everybody's talking about growth. So we figure, you know what, if rates go up, growth will bail us out, we should be okay, generally speaking. And everybody talks about the president and a 3% growth factor. But everybody knows that when you look at growth, it's two things. It's population growth or workforce growth, and it's effectiveness and efficiency in that workforce. I'll only say one thing. Anti-immigration as a policy is a direct and linear adverse effect to growth. So we do have to look at policy a little bit that way and say, if that was to happen, and I think we're all boomers on this stage, we're not around in a long period of time. So again, there's that coupling at times of policy and procedure about how we invest. So that's probably the one thing in terms of all the things we try to ignore that does bother me, and it worries me because I am with you. Like, I think rates are going to rise, and I'm not convinced that growth is going to bail us out. And if that happens, we have diminution of value. And NCREIF has, I think, still remains heavily weighted towards office. So when you hear that comment, you start to say, perhaps somebody's shorting office, which maybe I should stop talking about suburban office now. So anyways.
Well, we have just a few more questions that I had, and then I would open it up to the audience if you want to ask any of the panelists questions, because we only have a few more minutes. But yeah, we're kind of at this point in the cycle. We've talked about equity capital there. Obviously, the debt markets are very efficient. Execution's very good. Wouldn't you say, Mike?
Plenty of capital out there to support our business. I think relative value is great. Commercial mortgages are very popular and efficient with commercial lenders.
Right. So the one area that, as Chris started alluding to, what causes constraint is construction financing. I mean, is that regulatory? That's it seems like it's pulled back, and so it helps us maybe going into a slower economic cycle. Anyway,
it's interesting that I remember this quote vividly. We had one of the top banks, the biggest bank in the country, actually talked to us this week in San Diego, and they said, we always ask the question, what about construction lending? And they said, construction lending dollars are precious, and we only give those out to our very best customers where we have broad relationships. And so if you don't have that, it's going to go to the shadow banking groups, which is fine. There's plenty of those around. The other thing we heard the last few days is everybody's a bridge lender. Every single lender, they weren't a bridge lender last year, they are this year. So plenty of capital to support. There will be capital to support construction. It is disciplined, and it'll be much more expensive than it was 12 months ago.
Okay, so that hurts yields. Usually what you do is I'll just give you the house view at MetLife is, I'm chasing yields down. This is crazy. I can build on a return of cost or an unlevered IRR that's better than what it costs and just buy something that's existing. So then I take construction risk, I take market timing risk, all those things start eating in a little bit. I had a lot more hair before I did some of these development deals type things. So would you say at this point, we kind of touched on it here a little bit, the laggard has actually been office as a product type. I don't see a ton of it going up. Of course, Seattle's crazy because Amazon just occupies every building. They just took down a whole building of ours, some of you may know. In Seattle, we did 100% spec, and they just took down the whole building. But in general, if I have the Chris view of those are great improvements, maybe I can even buy at or below replacement cost. I should probably buy it existing. If I can't, do I go out on the edge? And these buildings are all costing around the country, depending on where we're going, construction costs, $400, $450 a square foot. So my rents have got to get up there, where maybe in some markets they haven't been before. I know, just your thoughts on that. And as far as office goes, since it is a very high quality product in many cases. Anyone?
It's funny. I was thinking about office construction and where I'm seeing it. In major markets, obviously, you're seeing some of it in San Francisco. You're seeing it in Seattle. You're seeing it in Chicago, Gulp. You're seeing it on the west side of Manhattan. You're finally seeing it around Grand Central and Park Avenue again. We didn't think we'd actually ever see that, with the One Vanderbilt going up now right across the street from my office. So again, I think it does come down to if it's the family in New York that has owned the land and has decided now they've got the remassing strategy to go vertical, versus the guy that says, I was a great retail investor, but I'm telling you, since retail is more complicated than office, I'll nail it. I'll just build an office building. Those are two different places. So on the construction side, once we get outside of the Bank of the Ozarks, it starts to get a little thin, right? And it really comes down to asset quality, location, and sponsorship. Knowing how risky office is from the standpoint of how far you go from rent to net cash flow and the volatility of that product type and the concentration of capital that's inherent in it, you really have to have the underpinnings of a great market and a great basis in the land and a guaranteed max contract with a superb GC. Otherwise, it's a little scary, to me at least.
Yeah, Chris, you want to make a comment?
Yeah, I think we could be in the middle of something interesting on this, in that there's a lot of functional obsolescence out there. So you've got, like, I never would have thought that a building south of Market Street, a 2-story former warehouse building with big windows and timbers inside the building, would get higher rents than the 40th floor of Embarcadero Center, right, in San Francisco. But it's true now. That's what happens. And so, nobody wants like consultant space, law firm space, accounting space with 8-foot or maybe even 9-foot ceilings. And there's a lot of big blocks of that on 6th Avenue in Manhattan and other parts. And I think what's being built now, is going to be, there's a lot of demand, like the entire Hudson Yards project. I think it's going to be 13 million square feet of office. And I mean, it's all funky and cool and high windows and open workplaces, and like it's where millennials want to work. There's a movement into that type of product. Now, what becomes of the old product, I don't know. Maybe it becomes apartments or condos or a hotel or some other kind of use, or a retail fulfillment center. I don't know. But I think that there'll be development spurred on by that new demand with where the millennials want to work, where they want to shop. Now, if the 4 property types were children, I would say that, I think everyone has a favorite child, even though you would never say it to your spouse or to the kid. But apartments would be mine, for sure. You mentioned about CapEx and leakage to the bottom line. I mean, highest total return, lowest volatility, lowest CapEx, always stays occupied at some, level. And you look at what's happening in single family home ownership continuing to decline, renters by desire coming, growing, that millennial group growing. The non-supply constrained markets for apartment housing, I think still, continue to be really, really strong.
Yeah, I mean, I'd put a little finer point on it in that speaking to investors who have bought or built the highest quality urban apartment environments for the renters of choice, right? Much like the condo environment in New York City, that becomes rarefied air at some point, and that concerns me. I do love the storyline of higher quality rent for necessity multifamily, especially if it's serviced on some basis by infrastructure. Again, the best part about the agencies is they seem to be zip code and continue to be zip code agnostic. So that loan to value that you get in one town, you might get in the next town, and the pricing's about the same. And I love the relative play on that, where you might get a better unlevered return. You have an agnostic agency that puts financing up to 75%, name it. That feels like a good trade to me. Now the best part is go find it. Right?
So what the largest apartment lender in the world told us 2 days ago was that, my notes, except for the highest top of the market deals, they have no problem at all with where rents are today for multifamily. And they have the biggest database of anybody in the world, and they're very comfortable with where rents are today, except for that ultra-luxury top tier. We should talk about Florida real estate. I think there's a few.
We're
people from
almost out
Florida
of
here.
time. I think it's like 3:50. Is that correct? We have time. I want to ask one question because I actually put it in here. Risk off. Now that you've heard of all this, positive again right now. Risk on. Investing in real estate, debt, or equity.
Yeah, I would say cautiously optimistic. I love debt at this point in the cycle. I mean, if we are at the late cycle stage, and there's 1 year to go and not 4 years to go, I think having a 65%, exposure to today's equity value is a pretty defensive place to be.
So you don't have a problem with it. How about you?
No, I agree. I mean, I think irrespective of where you look at values, if you're sitting at somewhere, call it 70% of the capital stack, I love that play. So even lower loan-to-value mezz feels really good to me right now, and I'm partially risk-on if you're asking me the equity question.
Okay. And how about you, Mike? Obviously, picking up the last year since you came back from the MBA.
I would say it really seemed like a risk-off time, and I would say that what most people we talk to, we're not that really worried about the next 24, even 36 months. So I think this cycle is different this time. I think that it's longer, and our house view, our economists at CBRE are saying it was going to be the start of the early recession in the end of 18. Now they push it off to the end of 19. That's the official house view.
Okay.
So,
All right,
I want a couple more years.
we are out of time. If we could have a round of applause for our panelists, I would appreciate it.